Hello, welcome to Money Gist. I'm Oluyemisi and here are the top stories for you this week. The federal government says 91 state-owned companies and assets will soon be sold or concessioned to private investors. On the list are big names like Ajaokuta Steel, Tafawa Balewa Square TBS, the Lagos Trade Fair Complex, our refineries and even 5 international airport terminals. The Bureau of Public Enterprises, BPE, explains that each deal will be handled carefully, one after the other, using legal, financial and technical experts to make sure the transactions are transparent and profitable. Meanwhile, the Bureau shared some progress in sectors already reformed. Telecoms now boast over 169 million subscribers, contributing more than 14% to Nigeria's economy. The internet and broadband markets keep growing, while e-commerce is expected to more than double to $33 billion by next year. Pension reforms have pulled in nearly 11 million contributors with assets worth over 24 trillion naira. At the ports, concessions have attracted more than $2.5 billion in investment, cut cargo clearance times, and boost government revenue. And in aviation, companies like NACO and SACO have grown their turnovers more than tenfold since reforms began. The message is clear. Government is banking on privatization and concessions to unlock growth, modernize infrastructure, and boost Nigeria's economy. The presidency says Nigeria is firmly on track to meet its yearly non-oil revenue target. Between January and August this year, government collected over 20.5 trillion naira from non-oil sources. That's a 40% jump compared to the same period last year. For the first time in decades, oil is no longer the main source of government's income. 3 out of every 4 naira now comes from non-oil revenues like taxes and customs duties. Customs alone brought in over 3.6 trillion naira, beating its target by 390 billion naira. The presidency says this growth is not a lucky break, but the result of reforms, stricter tax enforcement, customs automation, and digital tax filings. President Tinubu also pointed out that with stronger revenues, the federal government has stopped borrowing from local banks, freeing up credit for businesses and individuals. States are also benefiting. In July, for the first time ever, monthly allocations to states and local governments topped 2 trillion naira, giving them more room to spend on infrastructure, agriculture, and social services. However, all revenues are still struggling due to weak crude prices and missed production targets. The presidency says the real challenge now is turning this rise in revenues into visible improvements, better schools, hospitals, roads, jobs, and food on the table. Naira has been holding steady lately, and traders say 2 big factors are behind it. First, Nigeria's currency swap deal with China. Instead of demanding dollars, many Chinese businesses are now collecting naira in exchange for their currency, the yuan. That means less pressure on the dollar and more breathing space for the naira. Second is peer-to-peer or P2P, foreign currency trading. That's when people exchange currencies directly with each other on online platforms, cutting out banks and middlemen. It's another way demand for dollars is being eased. Now, Nigeria first signed the swap deal with China back in 2018, and it's just been renewed at about $2 billion. Remember, China is Nigeria's largest trading partner. Last year alone, Nigeria imported over 14 trillion naira worth of goods from China, while exporting just over 3 trillion naira. So the deal allows both central banks to supply each other's currency directly, yuan for naira, naira for yuan, making trade smoother and reducing reliance on the dollar. In simple terms, this swap is helping businesses on both sides and giving the naira some badly needed stability. Nigeria's ginger industry, once a star player in our agricultural export, is now in serious trouble. Production has collapsed. Prices have skyrocketed, and both local households and international buyers are feeling the heat. Back in 2022, Nigeria hit its highest ever ginger output, over 927,000 metric tons. But just 1 year later, a fungal blight swept through farms, slashing production to less than half, around 420,000 metric tons. That's the lowest in 20 years. And the price shocks, even worse. In local markets from Lagos to Kano, a measure of ginger that used to sell for under 1,000 naira now costs 12,500 naira. Small portions that once went for 100 naira or 500 naira now sell for 1,000 naira to 2,000 naira. For many families and small processors, ginger is fast becoming a luxury. The federal government knows the scale of this problem. It set up a national task force, released 1 billion naira in recovery funds, and announced another 1.6 billion naira for affected farmers, especially in Kaduna, where losses topped 20 billion naira. But farmers say most of that support hasn't reached them. Many are now experimenting with lab-grown seeds just to save the next planting season. Experts warn that government handouts won't fix the problem. They're calling for private sector leadership. So what's at stake? Analysts say if Nigeria gets this right, the ginger industry could bring in over 6 billion naira by 2030, up from about 4 billion naira last year. But without urgent action, the decline could deepen, leaving farmers, processors and exporters stuck in uncertainty. Global markets sent out a mixed set of signals this week. In the UK, government borrowing costs shot up to levels not seen in almost 3 decades. That's raising fresh concerns about the country's finances. Meanwhile, over in the Eurozone, inflation held steady, while Ghana continued to cool down its own inflation through steady disinflation. But in South Africa, business confidence has slumped to its lowest point in a year, a reminder of the structural problems that keep dragging growth down. Back home in Nigeria, though, it's been a week of big milestones in the energy sector. The oil regulator, NUPRC, struck a landmark deepwater deal with industry partners, and the Dangote refinery made history by exporting its very first gasoline cargo to the United States. That's a big win for boosting local outputs and strengthening foreign exchange inflows and giving Nigeria more weight in global markets. And there is more on the reform front. The Bureau of Public Enterprises says it's working to list power companies on the Nigerian exchange. If that happens, it could deepen our capital markets, attract fresh investment, unlocking funds for infrastructure, and importantly, push efficiency in the power sector. Let's talk money markets this week. The Central Bank of Nigeria was busy, first with its OMO auction, where it offered about 600 billion naira in short-term bills. Investors jumped in hard with demand nearly double that amount, and the final stop rate landed at a steep 26.44%. The CBN also raised more than double the amount of treasury bills compared to the last auction, about 480 billion naira. Again, demand was huge, crossing 1 trillion naira, and rates settled between 15% and 18%, depending on maturity. All that action sparked renewed buying interest in the secondary market, pushing average T-bills yield slightly lower to 18.57%. But in the bonds market, it was the opposite story. Average yields inched higher to 18.41% as investors sold off longer-term papers. Nigeria's Eurobonds also weakened a bit, with yields sticking up to just 8%. On the global front, crude oil prices slipped this week. Brent settled at about $67 a barrel and WTI at $63.05 as OPEC looked set to raise production to balance falling output in other regions. And finally, in crypto, mixed fortunes. Bitcoin gained about 0.5% on hopes of a US rate cut, while Ethereum edged down slightly as traders took profits after its recent rally. And that's all the money gist for you this week. I'm Oluyemisi. See you in the next video.